Okay, students, in this video, I want to teach you all how to record opening and closing inventory. Let me just recap. Whenever we buy goods for resale, we do not record purchases in inventory account. So the normal double entry for purchases is debit purchases, credit the supplier when it's a credit purchases, and credit bank when you pay by cash. Okay, so the inventory account is only open at the end of the year when you're going to do your income statement. Let's say in the first year the company starts its operations, there will be no opening inventory. So this account is not open until the end of the year. Let's say the company made a total purchases during the year of 20,000. Okay, and then as at end of the year, say it's 31st December 2019, or maybe earlier 2017, the company did a stock take and finds that it has a closing inventory of, let's say, 4,005. Okay, so during the whole year, the company bought goods worth 20,000, but at the end of the year they only have a closing inventory of 4,005, meaning the company would have sold goods amounting to 15,500 during the year. Now, end of the year, when the company finds that it has a closing inventory of 4,005, this would be the double entry. Okay, it will open an inventory account, then they will put the date December 31st 2019, and it would record on the debit side because now they have inventory of 4,005. So this goes to the debit side of the inventory account. Then in the income statement account, okay, let's create the income statement account. Income statement for the year ended 31st December 2019. Okay, it would have recorded the sales and purchases figure. Okay, let's just say the sales figure was, let's just create some figures here so you can see the income statement properly. Okay, so the sales figure, whenever they sell anything to anybody, they will record. Okay, just let's say total sales for the year, it's 65,000. Okay, end of the year, this figure would be transferred to income statement, 65,000. Okay, you would close off this sales account, by debiting the sales account and crediting the income statement account. So 65,000. That's my double entry to transfer the sales for the year. Okay, I'm going to highlight both of these entries in red so you can see it's a double entry to transfer the sales figure. And just now we said the purchases figure for the year, total purchases for the year is 20,000. So let me just record that. December 31st, 20,000. Right? So end of the year, the same total purchases figure will transfer to income statement. Just like we transfer the sales figure, we'll also transfer the purchases figure. So credit the purchases account and debit the income statement account. That would be my double entry. purchases 20,000. Okay, I hope it makes sense to you so far. Okay, let's say if we have carriage inwards, right? Let's just put another figure in. Carriage inwards. Okay, let's say we paid carriage inwards of 500 by paying check. Okay, 500. It would have been a credit bank and debit this account. Then end of the year, this amount would transfer to income statement by crediting this account. So notice here, all the figures that we transfer to income statement, we would have to do this entry, not balance carry down, balance brought down. We only do balance carry down, balance brought down for accounts that are shown in the statement of financial position. Those accounts would be your assets, liabilities, and capital accounts. So for those accounts, end of the year, you would have balance carry down, balance brought down. But for all your income, expenses, your sales, your purchases, your carriage inwards, your sales return, your purchases return, all these other accounts, the year-end entry should be transferred to income statement, which is this entry, not balance carry down. Okay, take note, this is important for you to understand. Okay, so let me just close off this carriage inwards figure to my income statement. So I would put this as another color. Let's say I'll put this as green. So you can see the double entry. Okay, so credit here, debit here. Okay, carriage inwards. So notice this carriage inwards is on the same column as your purchases. Just like in your normal income statement report, you would add your carriage inwards to purchases. That's why they're on the same side. Now, I wouldn't draw the return inwards, return outwards account. Return inwards is goods coming back to you. So return inwards is really your sales return. Return inwards would be on the opposite side of the sales. Sales is this side, so return inwards would be this side. Okay, let's put in a figure. Let's say we have a return inwards of 100. If you were to close off the return inwards account and transfer it into the income statement account, it would appear here. Now, let's say these are your only figures as at end of the year. Then, like I told you just now, the company did a stock take and found that it has a closing inventory of 4,005. Now, so what would be the double entry? You would create an inventory account, debit the inventory account because it's an asset, then credit your income statement. I will name this as closing inventory, so it's very clear. Okay, and I will put this as a different color so you can see that this is one set of double entry. Or maybe I'll just highlight this as yellow, then it's easy for you to see. Okay, so that's another set of double entry. So with this, I can already balance my income statement account. Okay, let's balance it. Obviously this side is more, so I will total up this side first, and this side's balance would be equals to this, and I know I would have a figure here which I will take this figure minus the sum of all these figures on top. So that's what figure is this? It's your sales less your purchases. Your sales side 65,000 is more than your purchases. You know this side is your cost of sales. So if your sales side is more than your cost of sales, it means we have a gross profit figure, and this is carried down. Okay, this gross profit figure, you will have a gross December 31st gross profit brought down on this side, 48,900. Okay, I hope it makes sense now. If you have any questions, you just continue watching. If you have any questions during our Skype class, you can ask me. Okay, I'll go on to show you this top part, right? It's what you learn in your income statement report, your trading section where they calculate the gross profit. Now, once we have our gross profit, what do? You add income less expenses, right? So if you do not know where does income come to this side or this side, it's very simple. You just draw up your income T account. Once you put in the figure, then you would be able to see it. I'll give you an example. Let's say if I have an income called rent income, right? When I receive rent income, I would credit my rent account. So let's say for the year, my total rent income is 2,000. I would debit bank, credit this account, right? And so, end of the year, I would transfer this to the income statement, right? 2,000 here, 2,000 here, and then this would be, I would put here to income statement, December 31st. So, this one is a debit entry. So on this side, it would be a credit entry. Rent income, that's my double entry, yeah, 2,000. Okay, this 2 is my double entry for the rent income, to transfer the rent income into your income statement. It makes sense, right? Now you have profit, add income. So obviously your expenses is on this side. Even if I were to draw up the T account for you, it would be obvious where your expenses will go. Let's say if I have a salaries expense, and let's just say that your total salaries for the year, okay, December 31st, total paid is, let's say, 13,000. Okay, this figure, if I were to transfer it to income statement, I will put a figure here, income statement, December 31st. Okay, double underline this so to show that this is the total to transfer, and I will highlight this as green. So credit this account, debit this side. December 31st, salaries, 13,000. Okay, so I'll highlight this. So that's my double entry for expense. So all my expenses will be listed on this side, gross profit plus income on this side. Now, if I think when you look at this income statement, you can already see whether I made a loss for the year or profit for the year, right? Because you can see which side is more. My gross profit plus income is more than my total expenses. So let's calculate. So this total is also equals to this side. And so I would have a figure here which is equals to this figure minus this figure, and this will be my profit for the year. Okay, makes sense? Now, so I'm showing you basically how to do the income statement as a T account. You have previously learned income statement can be done as a report format. It can also be done as a T account format. This is how you formally close off all your T accounts. So by doing this process, I close off my sales, my purchases, all the amounts that get transferred to income statement is closed off. And next year, these accounts like sales account will start off with zero balance. Okay, clear? So now let's go back to my closing inventory. So this one, the year is done already. Now next year, January 1st, 2020, the following year, what happens, right? So when I want to do my income statement for next year, this is what happens. Let me just erase all this, and then we are going to look at next year's figures. Now, this closing inventory from 2019 becomes, it has to be balance carry down because this is an asset, right? I told you just now, asset gets carried down to the next year. So this figure gets carried down to the next year. So this one I will double underline to show that it's the total figure. Then next year, January 1st, 2020, I start off with a balance inventory 4005. Now you can already guess what is this figure. It was a closing inventory for 2019. Now the next year it becomes an opening inventory for 2020. Okay, when I do my income statement for 2020, I have to first transfer this opening inventory into the income statement. Okay, now how do I do that? End of 2020, I will transfer this amount to income statement first. Notice this is a credit entry here. Okay, so I will highlight this as a different color, then you can see. Okay, so credit this account, debit here. December 31st, opening inventory 4005. Okay, just let me tidy up and you can see. Now this is the double entry to transfer the opening inventory for next year. So when you're doing your income statement for 2020, you have to first start off by transferring the opening inventory. After you transfer, now there is no more balance inside the inventory account. Then just like last year, you would transfer all your sales purchases figure, right? So just now we said sales figure would always come to this side. Okay, just let me put in some figures, then you can see. Okay, sales, let's say I'm making up some figures for next year. Let's say we have a sales figure of 80,000. Okay, and then we have a purchases figure of, let's say, 33,000. Okay, now let's say we don't have return inwards, we don't have return outwards, we don't have carriage inwards, and now we find out what is the closing inventory. Again, the company will do a stock take, and if they find based on the stock take they have a closing inventory of 1,002, they would do a fresh double entry to record the closing inventory. Okay, so to record the closing inventory, they will debit the inventory account and put this double entry, and they will credit the income statement account. So let's say it's 1,002 as your closing inventory. Okay, so that's my double entry for the closing inventory. Debit my inventory account, credit my income statement account. Now do you see? I shall repeat this. It's important for you to understand. Okay, so from previous year, that closing inventory 4,005 becomes opening inventory. When you balance carry down, balance brought down, it becomes opening inventory for 2020. This is 2020 figure. Okay, and next year, firstly you transfer your opening inventory into the income statement by crediting your inventory account, debiting your income statement. Then at the same time, the company will also do a closing stock take at the end of the year, and when they find that the stock take figure, they find they have a closing inventory of 1,002, they will put through this entry: debit inventory account, credit income statement. Notice that they are on different sides of the income statement. Okay, so then when you do this, you total, this side is 81,002, this side is obviously less than the other side. So with this, you can now find what is your gross profit, which is equals to this total minus sum of your opening inventory and purchases. That's your cost of sales. Sorry. This is equals to 81,002 minus sum of, so that's your gross profit. Then you will continue on with the process like what we did just now. But my purpose is to show you what happens to the inventory account. Now if I ask you then, this closing inventory for 2020, what happens to it? End of 2020 again, what do? You balance carry down to January next year, which is 2021, January 1st, balance brought down 1002. Then it becomes the opening inventory for next year. Now I want you to digest this and really understand what I'm doing here. Okay, digest your inventory account. Every time you record your closing inventory by debiting this account, credit income statement account, and then you carry down to the next year as opening inventory. Then opening inventory you also transfer to the following year's income statement, and then you record a fresh entry for closing inventory. You need time to understand this, okay? And that's how the inventory account moves from year to year. Okay, if you have any further questions, either you rewatch the video again or you can ask me questions. Okay, I will stop here, and I will also give you another account how to record drawings and capital in your T account. Thanks guys.